Welcome to episode 219 of the Numbers Game podcast. I'm here with Nick and Marty, and for those joining today, a little shout out to say, jump over to YouTube and check us out if you haven't watched us on the YouTube channel before, and make sure you hit that subscribe button. If you are on Spotify and Apple Podcasts, thanks again for joining, and make sure you subscribe as well. Nick, you're in the driver's seat today. What have you got?
Well, mate, today I want to talk about residential versus commercial property and the quickest way to get to your desired inverted commas, passive income. And we've covered this before on the podcast, mainly commercial property. I think we covered residential property probably every second episode. But
Hot
given
topic.
it is a good topic. You know, we all love property. It's Australia, greatest place to live. So I thought this would be interesting given what we spoke about, what Marty brought to the table last episode, mainly around the cost of residential property and how it's getting more difficult to own property as an investor or an owner occupier. And what triggered this was I did read an article in the weekend in the AFR, and I say that because I want people to think I'm smart. Smart people read the AFR Marty vids. And there was an article in there about a particular couple who are on a journey to create a passive income for retirement. And a very successful story, I would have thought, or scenario. But they started around 10 years ago, and they've got to a position where they have around $8 million in property value with a net value. So after taking away debt, with a net value of around $4 million. So that's pretty significant and also hard to do in a 10-year period. So it got my attention. And once I read the article, which we'll go into, but they then deviated to the fact that they realise now that residential property isn't going to get them to the passive income that they require, as they thought it would when they started. And they probably started, like most people, without a plan. Let's just buy as many properties as we can because that's the answer to getting to retirement earlier and building wealth. But this couple are actually now sitting back and saying, well, okay, if we keep going on the path we are, this is where we're going to be with residential property. To tick off our passive income goals at retirement, and for this couple, it wasn't retirement, it was having choice to work, having the ability to go on holidays. They realised to get there at the desired date, they need to reshuffle their portfolio and move into commercial property. And I think a lot of people would hear me say that and would say, oh, geez, commercial property is too hard. But when you read this couple's story, getting to $8 million in residential property for 99% of the population in 10 years is too hard. So I thought it'd be interesting to unpack that, why this couple has decided to do that, how you might look to get into commercial property, and also, as we've spoken about in the past, but also add a few more layers to it, why building wealth around residential property is very difficult now. So yeah, that's all I want to talk about. Thoughts, boys?
I like it a lot. There's a lot of conversations that are happening day to day at the Future Office that are around residential property versus commercial property. I think it is a great conversation that not a lot of people understand how commercial property works and where it differs from residential. I think the age-old Australian dream is to buy a property, but most people think of a bricks and mortar house on a parcel of land. Nobody's really thinking as a teenager or a young person in their 20s growing up going, geez, I can't wait to own a factory or a warehouse or something like that. So yeah, I think it's a great one to unpack.
Yeah, and I think too, Nick, just the parameters around buying commercial property, there's so much more flexibility for people to get in, and obviously, the yields are stronger as well, depending on where you buy, of course. But it's again, you're putting money back in your pocket, and what we talked about in the last episode is that's a very important factor. So I'm glad you're bringing this up, because it's usually people think about buying one or two resi properties, and then they're playing Monopoly, and they'll buy a commercial one on the fourth or fifth. But again, you're thinking about where's the value, where's the cash flow, and what's the strategy. So I like that you're bringing this up, because it gives us, our audience, alternate ways of thinking about building wealth in Australia.
100%. And, I think you mentioned something before that I also said, but we go into residential property thinking it's the answer to all the questions. You know, you talked about playing Monopoly. In today's, or in 2025, you sit back and you do the numbers, and in a lot of cases, passive residential property investment isn't that greater investment. I think what you need to do now is you have to have a skill set outside of being a passive investor. And there's a lot of influencers, if you want to call them, or just good quality buyers agents that are out there on social media at the moment, and they talk about building these multi-million-dollar property portfolios. Most of the people that are out there promoting that stuff are all doing a strategy that's not passive. It might be passive at some stage, but they're generally looking at buying and improving. So they're buying an old house and they're renovating it and they're increasing the rental income. They're putting another unit or a battle axe out the back, and they're creating two income streams off the one property or the one title or piece of land. They're buying in regional areas. They're buying in regional areas that they've studied. They know things about that area where most people won't. Or they're developing in some way, and that's getting harder and harder. People aren't building $8 million portfolios in the space of 10 years by buying a house in Nunawading, as you mentioned last episode, Marty, and then buying another one and then buying another one, because the numbers just don't stack up. You can't continue to do that, because the minute you buy that property, you're in a significant negative cash flow position, and you just cap out as to how many you can buy. So you can't just keep buying properties. There's a ceiling with the current rent versus the repayments and the other associated costs to maintain the property. You cap out for most people at sort of maybe 1 to 2 properties, most people on average incomes at best. So then you've got to look at, well, what are the alternatives? And when we're looking at buying investment properties, we've talked about this before, but you need to link it to a plan. What am I actually trying to achieve here? So for this particular couple, this story that I read was spot on. This couple wants to get to $300,000 in net income from their properties by a certain time period. They've got that mapped out. They know exactly what it is. So that's perfect, because they've got a plan, and they're looking at their strategy and they're going, okay, well, the current trajectory, we're not going to get there. So they're deviating. So the first thing is you have to have the plan, or you have to know what your end goal is. Then you can look at what you're doing and the activities you're taking on to determine whether or not that's going to work. So then we go to, what are the alternatives? And the alternatives for this couple were commercial property. Couple of things to be aware of. And Marty, I might get your input on this because I know you do a lot of funding in this space. But commercial property, we're going to look at pros and cons. Pros, better cash flows. Pro number one. Pro number two, less cost to maintain. Generally, the tenant is responsible for the cost to maintain. Pro number three, less emotional as far as purchasing. It's purely numbers. You're not buying, oh, we like that house because it's in a nice street. It's purely a numbers game. So it's quite often easier to make a decision on what commercial property to buy. Let's go to cons. A con being you need a bigger deposit. So I think you need around 30% to get in as a deposit point of view. So that counts a lot of people out. This can be a pro or a con. Long leases. So a tenant comes in and signs a lease for 3 years. Now, that could also mean that when that lease is over, it can take quite some time to find another tenant. So you can have longer periods of no rent. That's probably another con. Maybe linked to different markets. So retail at the moment, if you were unlucky enough to own a retail commercial property through no fault of your own, what's happened with retail is what's happened, and those properties are struggling, and now you've got industrial. But that's where the research comes in. But any other pros or cons you see in attacking commercial property?
I think you've hit the nail on the head here. You can borrow up to 80% on commercial properties now, so there's a bit more flexibility to what it used to be. But it's all about, and like you said, it's a skill set to learn. It's all about the tenant at the end of the day. You know, the strength of the lease is what provides the value in the property. And I think what you generally find, the resi market, it's sort of suburb to suburb, house to house, all going up in unison at the pace it goes up. Whereas at commercial, you know, you get a quality strength of tenant, and that could really, you know, increase your value quite dramatically. So it's more business minded, and yes, you do need additional skills around it, but it doesn't take long to work it out as to who's going to be a great tenant that's going to give you the best bang for your buck. That's why you rarely see, from my perspective, I rarely see commercial properties being sold untenanted because of the risk and devalue of that. So again, as long as you know the parameters of what works, you can create value as well as cash flow. That exactly like you said in your in your demonstration of that couple, that can be really lucrative. And what I love was, we want to earn 300 grand in passive income. This route is not taking us there. We need an alternate route. That's why I like that idea in commercial, because again, are we waiting for capital growth? Are we using a bit of negative gearing, hoping that we're getting our 7% return? You know, whereas here we've got legitimate expenses as well we can claim back. More cash flow coming in on what the tenant covers. So really like the way of thinking with the goal.
I'm so glad you brought that up, because I was guilty of this. I'm a residential property person. Obviously brought up in the mortgage game, I guess, from a career point of view. So for me, it's always been residential property. We know what's going to happen. More people moving in, but residential property, even from, you go back to when I started the business in 2007, it was always negatively geared from the start. Like if you bought Metro Melbourne or anywhere close to Melbourne, it was costing you money on a weekly basis. Absolutely no doubt about that. What has happened, though, is we've had exponential capital growth where you ignored that. So the whole idea is negative cash flow position. If you're a good income earner, you get a good chunk of that back from the ATO. So the ATO pay for half of your net cash flow deficit. But you know what? That doesn't care, because that doesn't matter, because this place is going to double in 10 years' time.
Yeah.
So you'd look at the money you were putting out, and I would suggest you wouldn't even think about it or calculate it, because you're just banking on the fact that it will double in 10 years. And that is what's happened in most cases. Based on what we've been talking about on this podcast, we're now at 50% on average of our net income going out to mortgages. So the question is, does residential property have the ability to perform from a capital value point of view at the same rate that it has? And if it doesn't, when you've got a negative cash flow asset and you're reliant on that capital growth, if it doesn't come, you've actually got a really bad investment. And I'm not saying residential property is a bad investment. I think it's a great investment. I just think we need to get a little bit more granular on what we want to achieve, and more granular on understanding what resi property is actually going to do for us, and is it the best solution. And I'll just go through this scenario that was put together, and then I might pass it for your thoughts, Jace, just on whether or not you've got clients doing different types of things versus residential. But the comparison that was done was a $1.5 million property purchase. Now, that might seem like quite a lot, but it's quite normal these days. So that could be a really good property in a blue chip suburb in Melbourne, or that could also be a really good commercial asset. 1.5 will buy you a really good sized industrial warehouse or somewhere. Let's assume a 30% deposit, because you've got to put a 30% deposit down on a commercial property. So let's assume you also put a 30% deposit down on that residential property, so we can compare apples with apples. Commercial properties should generate on average around 7% return, give or take, from a income point of view. Probably a little bit less than that now. But the commercial property could generate around $40,000 per year, or just under. The residential property, if you look at, so that was net. So when you take into consideration the income that it generates, you take away from that the interest component, you should be cash flow positive on the commercial property by about $39,000. A residential property based on a probably 3.5% return in Melbourne from a rental point of view, tack onto that your rates, your insurance, all these other things that go with owning a residential property, you're at a loss of about $14,000. Now, there'll be people out there that'll say, well, you'll get half of that back from the ATO. You may or you may not. It depends on your cash flow position. The way we always suggest to look at property is ignore the tax position, because you don't know what your tax position is going to be in 5 years' time. The ATO could change the rules. You look at the numbers before the tax. So you've actually got a $53,000 difference in cash flow between one asset and the other. Now, what you need then from that residential property is you need a 50% uplift in capital growth beyond the capital growth of the commercial just to get even. So when you're a couple, like in the article that I read, that are getting close to retirement, there's a timeline around it. They haven't got time to sit around forever. They're looking at that and they're saying, well, and this particular couple believe that if they convert their current $8 million residential property to 50% commercial, 50% residential, they believe they will increase their net yield by $100,000 over the next 5 years. And that gets them to where they need to be quicker. So you start to compound that, okay? So, I haven't got a compound calculator in front of me, but you think $50,000 a year difference year on year on year on year on year, you think of the significant upside that can have long term. And of course, there's the argument around, well, we know what residential property is going to do because people are moving in this country. Commercial, yes, it might have some more risks, but to your point, Marty, find something you can improve. Find something that, if the cash flow is 40,000, how do you turn that into 60,000? By maybe it's an industrial place that you build a second factory on. So that to me was a real eye opener. And look, we see it in our business. We see people come to retirement. They've got all this residential property. They can't keep it. They've got to sell it because the cash flows don't make sense. They don't have the income anymore to fund the catch deficits. They don't get the tax rebate anymore because they're not earning the personal income. And they end up getting to retirement and selling their portfolio. Versus a lot of people that are retired that have commercial portfolios will retain them because they're cash flow positive. It's not costing them any money. So food for thought. Jace, I'll pass it to you, mate. Have you seen clients with resi versus commercial portfolios?
Yeah, definitely. And the strategy that you talked about with the residential one is the all too common. It's looking at it, how do I negatively gear so I can get some money back from the tax man? There's a lot of the wrong mindset around basically losing money out of my pay every week, knowing the ATO will give me some back, to then hopefully in 5 or 10 or 20 years, I've made a capital gain, which is not guaranteed. Now, obviously, we talked about, statistically and historically over 60 or 70 years, yes, property prices are going up year on year over a long period of time. So you got to be able to hold that asset. But then also you got an asset that, has repairs that you got to pay for, has issues that go on, has the costs that they're not taking into account of all the other things that are happening. And then interest rate changes. I mean, a big one over the other side of COVID, when interest rates started going up, we had plenty of mum and dad investors that had a couple of properties. And the first thing to go was that strategy. So the one thing I love that you talked about, this couple, their strategy was to be able to have 300,000 of passive income. It was a plan. It was, thought out. They had a game plan. They were acting towards it. Great. What happens when something goes wrong with the plan? You got to be able to have, contingencies. These people that had poured their heart and soul and their hard earned into owning a couple of residential investment properties, as soon as the interest rates changed, the property prices also weren't doing anything amazing for the areas where they were in, and they had to sell. Now, they didn't get the huge capital gain that they wanted. They negatively geared themselves into a position where, cool, they got 50% or 45% of it back from the ATO based on their marginal tax rates. But at the end of the day, they've now sold a couple of properties. They've got the cost of accounting to do that as well, and they're back to not quite square one, but not where they thought they'd be. As opposed to passive income. The amount of people that come in for appointments that haven't thought about how can I get more positive cash flow? How can I get more cash into my pocket? Because there's too much of a stigma or worry about the ATO taxing the profit on a property or taxing the rent that I'm getting. But if you're making money, I think, that again needs to be a bit of a reshape or a rethink of this in Australia, is that if you're making money and you're getting taxed, that is a good thing. It means you're going to have more money left over in your pocket than if you're negatively gearing, shelling out money and waiting for a refund. Your net position, you're worse off. You've got less cash, unless you're waiting for this capital gain one day.
You said it so well, Jace. It's like, if you lose your job tomorrow, is that asset helping you or is it hindering you? It's a big, simple question. And again, I think it's like we talk about it in managed funds, Nick, in investing. You got to diversify. You're not going to have the same stock that you're just going to hold. You're going to diversify your stocks. It's the same now in investing outside of that when you're making decisions like that. Maybe, like we said previously, it might be, if it's a resi, you might subdivide the back, put the equity in, and you've got a cash flow positive property. Unfortunately, 4 years ago, when rates were 2%, that 30 grand was probably coming in on some of those investments. Maybe not that high, but at least 5 to 10 grand, where people were feeling good about it. Makes total sense. And then obviously the rate increases killed that. But you've got to be nimble enough to make strong decisions in the here and now. Love that. Love that, what you're talking about.
And I think it's really timely because of what's happened in the last couple of years on resi property around, let's single out Victoria, but I don't think it's just Victoria, but there's compliance rules, the cost of insurance because of flooding and all these things and fires. The rules changes that are more lenient towards a tenant now. So, it's all good and well to say, well, we'll just go put another place out the back and get more income, but that's another tenant. That's another set of laws. That's another dishwasher that could break down. All these things, and this is what we're hearing, right? This is what we're hearing from our own clients about residential property. So I think people are in a position at the moment where they actually are selling down residential property. We know that for a fact.
Yep, definitely.
And they've probably got means to fund a 30% deposit on a commercial property. It's another alternative. I think people are going to be cashed up and in a place to do it. You really do need advice around it. You need to understand what you're buying. As I talked about retail, you really need to align yourself with an expert and understand, what asset you're buying and the pros and cons as we spoke about. But the reality is the numbers don't lie. So if you get it right, it's pretty significant upside.
I didn't fully finish as well. Sorry, I went on about capital gains to actual cash flow. So your example of the two $1.5 million properties, and this is where if you're sitting back going, everyone does residential. I don't really know too many people who do commercial. Those people doing commercial, the quiet ones in the background with the extra passive income, listen to the numbers though. So you're looking at about $40,000 of positive cash flow because the rental yields on commercial property is higher. Now, again, we talked about on the residential side, you've got to lose some money per year to be able to then get some money back from the ATO. But the difference there is generally on a $1.5 million property, the example you said with residential, because you're the one shelling out for council rates, water rates, all the insurances and everything else. The difference here, the big one, is in a commercial property, the tenant pays for all the outgoings. That is your biggest cash flow difference of residential versus commercial. So the difference there ends up being, close to nearly 50 grand. I think it comes to between 40,000 positive income and a $13,000 or $14,000 rental loss on a residential property. There's a massive amount of cash flow difference purely because of the rental yields and who pays for what expenses on a commercial versus a residential.
I'll give you an actual client example. Really good client of Innovates and a friend of ours, and he's got a couple of factories in Melbourne. Marty might Jerry who this is. He's got a few residential properties, and of course there's the cash flow piece. But one of the things he said to me, which resonated, because I've got some residential properties and I can really relate to this, is he said, Nick, I never hear from the commercial tenant. He said the residential tenant, because he manages these properties himself, the slightest issue, he said, they call me. And he said, I go in there and I, bang this, do that, it's fixed. And he said, you just shake your head, you walk away and you think, Why didn't they just fix that? Most people would have just sorted that out. He said the commercial factories I've got, for starters, they're sheds. So there's not much that can go wrong. And he said, secondly, you've generally got tradespeople in there and businesses in there. So if there's a little thing that goes wrong, they just fix it. They don't call the managing agent. If a tap breaks or something, generally with a trade, they just fix it. So he said not only the cash flow, but he said there's just no noise with the commercial. I never hear about it. All that happens is the rent gets put in my account every week. He said or every month. He said whereas the residential properties, he said at least he's got two or three. He said at least every few weeks I'm getting a phone call. Something needs to be fixed. Oh, this needs replacing. So he said just the peace of mind too with commercial has been a game changer. So that's not really quantifiable, but I think in today's day and age where people are fed up with tenants and tenants whinging about things, I'll say whinging, but I'm going to say it. I think people are just, it's not even about the money anymore. They're just annoyed at owning investment properties. So I think commercial can also be that breath of fresh air where you don't hear from the tenant too often.
Yeah, apologies to my landlord. At the time, I thought I didn't know how to get the old dryer off the wall. So I was like, and it got left behind when I moved into this rental property. And so I logged a thing. I'm like, oh, the dryer, it's on the wall. It's old. It's broken. And they sent a tradie and he walked in. And he just went pop, pop, and it lifted off the wall like it was like it weighed half a kilo. And the guy just looked at me like, can't believe I've dragged out to Chapel Street in the middle of peak hour.
$280 call out fee.
Yeah, to lift a dryer off the wall for you. Look at those soft accounting hands. Obviously haven't done a hard day's labour.
Jason Robinson destroying the heart of investors out there. He's behaved. But look, I love what you're saying, Nick, and I think, there was a time to buy there in Brisbane and, WA as well 3 years ago. Money does get cheaper if you're buying well. So it is timing in the market. And, those properties now have virtually gone up 30, 40%. And, the debt levels are at a point where, you're probably cash flow, still cash flow positive. But again, you've got to have a plan. And now you've got to look at commercial. It's probably understated now. Cash flows are good.
I just want to make it absolutely clear that we are very pro residential property.
Absolutely.
Great investment, great asset. All that I'm saying is what we see over and over again in our business, and why this article resonated is it doesn't answer the retirement. For a lot of people, it doesn't answer the retirement problem or doesn't fix the retirement problem. They end up selling because the cash flows aren't good enough to fund their retirement. See it over and over again. And they hit a hurdle. They hit a ceiling pretty quickly because of the cash flows in regards to how much they can actually buy or how many properties they can buy. So love the asset. It's going to continue to grow. I just think if people are chasing passive income, they maybe need to think sidewards and have a look at commercial.
Well, and maybe they need to call the fabulous team at Innovate and have a chat. I mean, not that we're going to close every episode out with a call out to say call Innovate, but I think it's great. But last episode, Marty, you also said learn, learn, learn. I think as well, you could listen to, and look, if you're here listening to the podcast, you're obviously on the right track, but there's so much education out there to be able to learn to, if you buy a property, I think you called it a battle axe, Nick, that would be cutting the property to put a granny flat on the back. That's what it's called. Yeah, I think so. I had to think about the shape of it. Yeah, that's Jack Henderson. But there's heaps of resources out there now. Now, while sometimes we can hate social media and the internet can do our heads in, if you go looking in the right places, there is education tools. There's often free, sessions, free webinars, free strategies. At the end of the day, you can do this learning and research, but at the same time, you also then want to go back to someone you trust. So, if you've listened to this podcast for a while, or if you're new here, Nick and Marty and their team, great people to go and chat to about these strategies, what's right, what's wrong for you, because everybody's got a different situation. And I would also say, look back through some of our previous episodes. There's heaps on building wealth, real estate, tax saving strategies and whatnot. So there's plenty for you to go through. We'd love to hear from you, and we'd love you to hang around for more episodes to come. Until next time, though,
diversify and thrive. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.